Good morning and welcome to BST Live, or maybe it's afternoon or evening for you. It's morning for me here, nice and early, and glad you could join us today. We're going to be talking about how to map market probabilities using something called edge stacking techniques. Sounds interesting? Well, let's get to it. Well, good morning, good afternoon, good evening. Glad you could join us today. We're going to be talking about mapping market probabilities. It's a bit of a tongue twister, so early in the morning. And joining us today is our special guest, David Steets from Systematic Individual Investor. G'day, Dave. How are you?
Hey, Andrew. I'm good. Thanks for having me.
Excellent. Well, so where are you coming from? You're over in Europe somewhere. So where are you currently?
I'm in Munich in Germany, and it's dark outside, so it's already evening here.
Okay. Well, it's also dark outside here, so we're getting ready to start the day. So I've got the blinds shut and the lighting's a little bit off, but I can't wait to talk to you about mapping market probabilities. It's a very interesting topic. So before we get into that, though, do you want to share a little bit of your background so that people understand where you're coming from and put a bit of context around our discussion today? So how did you get started in the markets, and also if you can talk about the markets that you trade and the style and things like that, that'd be great.
Sure. I'm an individual investor, as my blog's site name tells. And I'm not a financial professional, but I've been trading in the markets for more than 20 years now, coming into the .com bubble and everything. And what it's basically all about for me is finding a way to trade my own capital that is working for me personally. And I'm writing a blog to share that process. So what I've come down to doing is having a long-term investment portfolio on one side and try to integrate a trading approach that is more a swing term, 1 month time frame overlay over this long-term investment portfolio. This is mostly centered around equities and some other asset classes like bonds or even just cash in risk-off environments. And I try to build systematic frameworks and models, including fundamentals, technicals, to trade trend as well as mean reversion strategies in a framework that connects them all together. That's basically what has turned out to work for me.
Okay. Well, we're going to be you're going to be sharing some of that with us today, which is great. So I think that some people might think or might consider what you're doing a regime analysis and making sure that you're looking at the market context before you take trades or investment. So I'm looking forward to dig into that because that's a very popular topic with our audience. So I think they're going to get a lot of interesting insights out of the way you do it today. So where to start? Well, how about should we start talking about probability maps?
Yes, we could start out with the basics for that, which is this model I've developed, which I call the meta strategy, which is sort of my basic overlay over everything, which is exactly what you said. It's defining a market environment that tells me whether to be invested in equities or in risk-off assets at any given time, and also defines what kind of strategies are good to use for the current market regime and how to link this investment portfolio with specific trades. So I have a portfolio exposure, an overall net portfolio exposure that is suitable to the current market environment. And that's basically what you were asking about. The probability map is exactly this trading sleeve, which is overlaid over the investment portfolio.
Yeah, okay. Well, I understand that you've got a couple of slides for us to talk us through the concept here. So should we get a look at those and start unpacking this a little bit more?
Yeah, sure.
Yeah, so let me just pop that one up on the screen, the first slide. And now this one's quite large, so I've just put it here as an overview, but we will dig into it in more detail in the next couple of slides. So if you're watching along and you can't read any of that, don't worry, we're going to zoom in. So what are we looking at here, David?
Okay, so this is my basic weekly probability dashboard that I do, which shows my expected returns for equities, which I'm centered on over 3 different time periods. It's basically on the top level, you see the current expectations for the next month, which is a bit of a wider range, so it's 1 to 8 weeks. Then the left lower one is the medium term, 3 to 6 months, and the last time frame I analyze is the long term for my investment portfolio, which is around a year.
Okay, so do you want to zoom into the first one and have a bit more of a detailed look? If I can,
have a detailed look, and I'll talk about how I get there, what I'm actually trying to accomplish here.
Yeah, and so, by the way, sorry, is this the current probability map for the market today, or what date is this example? Do you remember?
Yes, that's current. That's
okay,
from
excellent.
Today.
Right. Okay, sure.
Or actually tomorrow.
It's from the future. Awesome.
It's a future probability.
Yeah.
So it shows a slightly negative expected return over the next month. That's what this basically means. When the needle is just pointing up, it's 50-50. So my portfolio would be neutral. In this case, I would aim to be slightly net short overall with my entire portfolio. And how I get there is what I've always been struggling with in the past is to put together many data points and ideas into a systematic model, which is really too difficult for me personally to program as I'm not a computer specialist. And what I've come up with to help myself basically is to develop a framework where I can include all these different data points, edges, little strategies, all with the idea that I can use whatever works really well at the moment and get a portfolio that hopefully has higher and more consistent returns than just a simple long-term investment or buy and hold investment.
Okay. Do we want to jump on to the next couple of slides as well, so we can look at the other?
Yeah, you can just run them. You can just run them in the background and just ask general questions, because it's not so specific on these slides. They're all they're all the same, just on different time frames.
Yeah. Now, just towards the end of that explanation there, you touched on why this is important. But can you expand a little bit on why do you think it's important to be able to map out the market probabilities, the impacts it can have on your trading and investing?
I think what's really important is that the market for me is like a really complex 3D puzzle, maybe. Where you have lots of different things coming together at any given time. Some are important, some are not so important. A lot is random, a lot of it is noise. And this probability framework that I've developed just really is really flexible to be able to incorporate everything that matters at the moment, whether it's a historic markets study or a trading setup, or any other source of edge, and it spits out a really clear, concrete portfolio exposure. So I can trade according to it, just to fulfill the exposure it shows in the probability map.
Yeah. So how did you actually come up with this idea?
Well, what I've always really been interested in is these long-term risk premia returns or factor returns, or also long-term strategies like trend following. And what I'm trying to do in the probability map is to do sort of like a Bayesian probability process for dummies. So it is basically because I'm not a mathematician, it's very rough, but it's that's what I aim at, to be roughly right, but rather than exactly wrong. That's the idea. And what I start out with is always a base rate, which is for the S&P 500, for example. It's a statistical analysis of returns over the last 90 years, and it just shows what are the base expectations for a return over the next week, month, half year, which is a very, very strong driver of returns. I think that's the strongest basis any investment strategy, unless it's very, very short term, has. And then I can add on top of this base rate a data point that contains an edge. And maybe that's an interesting point to define, because edge is a term that is thrown around all the time.
Yeah.
And what I mean by it personally, I don't know whether everybody means the same thing by it, is something that tilts future return probabilities away from this base rate. So when you analyze historical data, for example, in a market study, for example, a momentum study, or what is currently pretty much studied is put-call ratios. What does a current situation in the market in history, in the past, show over certain time frames? And I can give an example for it, but because often it's a little bit unclear when I talk to people who read my things. That's questions I get very often.
Yeah, sure.
And for example, if you take a momentum study and it shows you that the 2-month returns of this particular market situation that we're having today is a 40% positive return, which means it's actually a negative return. What you're expecting, 60% negative return. Over 12 months, it then shows a 74% return. If you take this for an example, you have to lie this analysis next to the base rate to see whether it has any significance at all. And you can see that like a 74% 12 months return doesn't really have any statistical significance at all, because it's exactly what you expect from the base rate. So the study doesn't really tell you anything. So there's no edge to it. The edge is just the basic equity risk premium. But the 40% over 2 months is vastly different from the expected roughly 65% is the base rate for a 2 months period. So if you take that is actually a really significantly different data point from the base rate. So I would call that a short-term edge.
Right.
And what I then do with these two things, you have the base rate and the edge, the data point. I do a little bit of a discretionary weighting, how important that is, and then I average the two out. I average the base rate, and then I add my edge to it, and then I have my probability result, basically.
Yeah. Okay. So I think we've actually got a slide that explains a little bit about how this is constructed using the edge stacking technique. So if I just put this one up on the screen, let me get the right button here. This one.
Yeah, exactly. That's basically the analysis that goes into the dashboard. It's the best dashboard in table form, which shows a little bit more detail. So what I do is I start from the base rates, from these basic return probabilities, which you can see in gray in the top.
Yep.
I then analyze the market pretty much on a weekly basis. I look at my own studies, my own backtests, but also a lot of data I find on Twitter in services that I subscribe to. I just collect a lot of data from everywhere. I put the data points, if I consider that they contain some sort of edge, into buckets. So I put them into a short-term bucket, a medium-term bucket, or a long-term bucket, depending on the significance of the edge they contain. That gives me an average probability in each time bucket, which you can see for the long term, for example, it's in light blue, and then medium term is light yellow, and short term is light green. Then I average these probabilities across the time frames. So you get the dark blue, the dark yellow, and the dark green. And the dark green is basically what I aim for. It's the result of my probability map, because it shows the probabilities for the market returns that I want my portfolio to be exposed to at the moment. That's for the next month or so. I want to be exposed 60% short, basically, at the moment.
Yeah. Okay. I'm going to ask you, I think we're going to dig into a little bit more about these edges in a little bit, but I just want to ask a little bit more about this. We've had a question come up in the chat about dimensions. Actually, let me put it up on the screen. Just one moment.
Yeah.
I think you've probably just answered this one, but it leads into my next question. So I just want to put it up. This one's from Chango. G'day, Chango. Along which dimensions do you classify these market regimes? So as you just mentioned there, you look at short-term, medium-term, and long-term. So I guess maybe the extension of this question is, why do you look at those terms specifically? What is it giving you for that?
Well, basically, the market regime is my base case for the probability map. So that's more of a long-term analysis. So I use fundamental indicators and technical indicators. And the technical are mostly volatility and trend. So along these lines, I have bull-bear regimes, which are volatile or quiet, just pretty regular stuff. It just shows me the long-term market regime that I want to trade in line with most of the time. And within this long-term uptrend, for example, at the moment, there will be a lot of mean reversion happening around that long-term trend. It's like shifting tides. So that's why I concentrate on these different time horizons. So if I have a long-term 1 month, 1 year horizon going for a long-term uptrend, I might position myself short if I have enough evidence, because a lot of the time over that short time frame it is an expectation of a mean reversion below that long-term trend. And then when that tide turns again, I might go extra long, leveraged long, because the trends and the mean reversion align. For example, the uptrend and a mean reversion back from below the uptrend up to the uptrend aligns for really, really extraordinarily good opportunities that are really special.
Yeah. And
this is based on one of the groundbreaking momentum studies. I have it here somewhere in my notes. It's from 1993 by Jagadish and Titman. It's called. They're the authors, and they basically started putting these time frames into these buckets: the 1 month mean reversion, 2 to 50 months momentum, and 3 to 5 year mean reversion. And my own experience and all newer studies that I read actually confirm this since the 1990s when it was first published.
Yeah. Okay. Thanks, David. So you just gave us an example of an edge that you might consider. But can we dig into that a bit more about how you actually go about choosing which edges to include? Like, how do you determine that perhaps a piece of information actually does contain useful information, or it does contain a historical edge?
Yes, I think that's basically the main amount of work I do. That's my daily research to figure out very flexibly which edges are really relevant at the moment, where what really matters, what really works, and it's all based on an evidence-based quantitative analysis using backtests and market studies. And I get a lot of my ideas from academic papers, but also practitioners that work, podcasts like this one, blogs, Twitter. And the basic idea is that to be able to outperform, you do need to find an edge that is real, or a stack of edges that are real, and capitalize on these inefficiencies in the market. You really need to exploit them.
Yeah. Okay. So can you tell us some more about the process then? Like specifically, if you read something in a research paper, how do you go about validating it that it's useful? Because as we all know, sometimes things on the internet aren't exactly true, or that sometimes edges die, right? So what's the process you go about validating? Is it a good bit of information or not?
What I try to do is first see whether the source is good. That's the one thing. So that's really half the work, I think. And especially for long-term edges, investment edges, factor investings, there's a lot of studies done by a lot of different people, and if they all come to the same conclusion, I'm quite fine with it to accept it as something that is useful. And what I personally do then is do backtests for my own specific strategies that I develop there. For example, a trend following strategy. How does it play out? Where are the drawdowns? And things like that.
Yeah. Okay, so can we talk a little bit about the types of data you use? You've given a few examples of technical data like momentum, which you can see on a chart using indicators or other kinds of calculations. But are you just looking at technical? Do you have fundamental, anything else that drives these models? Can you give us some insights into the type of data you're looking at?
You could pull up that chart that I gave you. That's one of these. That's one of the basic fundamental analysis. The next one, I think it is.
Yes. This one.
So yeah. So that's basically a fundamental indicator. It's the 10-year Treasury versus the 3-month Treasury yield curve, which is quite a good recession indicator. So it's for the long-term investment model. It's one of my my go-to fundamental indicators, and I like to do these visual analysis charts to go about it. So you can see the red arrows, which show an inversion of the yield curve, and the recessions that follow. These are the gray lines in there. The blue line is the yield curve itself, and the yellow line, which is a little bit faded, but maybe you can see it, is the S&P 500. So you can see quite well that this yield curve inversion works quite well, especially if it's clustering for a while. There's a couple of signals before really bad bear markets. So that's one example how I do my own back tests. And you can see a lot of these charts and the analysis in a free ebook that you can get on my blog, which is called the Meta Strategy ebook, where I explain the entire strategy and how it works. It's the investment strategy.
Yeah, yeah. So, what about the reliability of edges over different timeframes? Because you touched on saying mean reversion over a shorter period of time, and then momentum over longer. How do you? I mean, how do you know that an edge, if it's a shorter period, how do you know if it's still working or if it's broken? Like, what do you do about edges that perhaps even decay over time?
Well, I think the longer term the edge works over, the more reliable it is. The best example are the base rates, which is for me the most reliable base expectation that you should always work with. For example, stocks go up by about 8% a year over the long run. And when I move down the ladder towards the shorter time frames, I consider each shorter time frame to contain less reliable edges, and more so that they change and evolve all the time in these shorter time frames specifically. And below 1 week, for me personally, everything's mostly noise, random noise. So I don't really include that except in very specific situations. Let me see whether I've written out some current ideas. For example, an interesting thing that was working quite well recently are the analysis of option market liquidity flows. For example, the gamma exposure, which has been written about quite a lot recently, and I've included a lot of these edges in my work recently. So on the blog you can find a few articles on this.
Yeah,
and that's one thing that is really reliable in the short term, because you have market participants that have high volume that are forced to do something. They are basically option dealers that have to hedge their exposure depending on where you are in the current market. So that's quite a reliable behavior, which is not, they can't really change it because the edge has been arbitraged away or something like that, or everybody discovers the same pattern or something like that. But it's a price insensitive behavior. This is where I think the best shorter term edges come from. And another example for that is, for example, if you have you take the recent inclusion of Tesla into the S&P 500, and you can see a really interesting edge playing out, which is that the new inclusions into a large index like the S&P will, from the time of the inclusion, a little bit after that, start to underperform significantly, especially underperform the issues that have been erased from the index. So the ones that have been kicked out outperform, and the other ones that have been included, like Tesla, underperform. And that's a really significant edge and difference in performance over time, which is really interesting. That plays out over about a month to 6 months. Is this period of the main underperformance. And in the case of Tesla, you could really see it. It was included, it was going up, especially before, because everybody has to buy the stock indiscriminately without any consideration for price, because every ETF, every mutual fund has to include Tesla now because it's in the S&P 500. And after it has been included, this outperformance continues for a little bit, and then it just drops. Doesn't happen every time, but over a lot of issues, a lot of securities, it really works very well.
Yeah. So what about if you've got these edges like the one you just shared there, which plays out over typically a specific amount of time, and you're stacking them together, you're bound to get some that conflict with each other, right? So how do you especially when you're looking at different timeframes as well. I guess that adds an extra dimension. So how do you manage that? Like, what are you doing when you're seeing conflicting edges?
That's a really good question, which basically goes back to the reason for the probability map and why it's separated into different time frames. So if you have a long-term trend, a mean reverting swing is just completely normal, and if it has a reason and it's not just completely random, it tends to show up in different studies as different probabilities over different time frames. So, for example, in February, we had several, if you look at the market through the lens of sentiment, through positioning, speculation extremes, you could see quite a lot of data points pointing to a short-term negative edge for negative returns. And put them all together, they will trump the base rate. So you have a very slight short exposure because you can never have a complete, all the edges going into the short direction, because the base rate will always be a strong positive force. When this turns around now, which, for example, after a correction of 10-15%, if we see that ever again, you will have a potential situation where all the timeframes align, and you get an edge alignment across 20 studies, for example, which all show you you can expect mean reversion that is positive, you can expect momentum that continues over the long term to be positive. And this is a really great opportunity to leverage the portfolio just for this time period, which is much more risk controlled than running a highly leveraged portfolio all the time. And just go in with the maximum exposure you're willing to risk. You define certain risk points where you say, I'm wrong, I'm out. But the edge stacking shows you such a strong probability that you have a really great opportunity to profit from that. That's where the main profit of the year comes from these situations.
Right, okay. So then what about if the majority of the edges are pointing downwards? Do you use that as an opportunity to go short, or is that like a risk management time, go on a holiday? What do you do?
It is a little bit.
Go on, sorry.
It is a little bit more about capital preservation in these things. Like in a bear market, when you have the investment portfolio out of stocks or even short stocks, it is possible that you have a lot of long-term and short-term pointing in the same direction. So you would be more short than in a bull market like right now. Right now, I can probably get to maybe the probability of 70% pointing down. Right now it's 60%, but it doesn't go any further than that. And then in a bear market, when the long-term trend points down as well, you could probably get to 75 or 80%, which means you could have a portfolio that is leveraged short. I would do that, but only about half as leveraged as the long side.
Right, okay. And so how often do you update your model readings?
I write this out in a short market report every week. And if there's something significant happening, I do that whenever something happens, when there's key levels breached or certain studies come out that tell me, right now there's something happening which is really relevant. I update it in between. But otherwise, it's basically my Monday morning work to update the model.
Yeah. Okay. And what about then also from the aspect of updating which edges are included in the model? Perhaps you need to look at decaying edges and whether they should be taken out. How often do you do that regularly to look at the constituents, or how do you manage that?
I basically concentrate on what has been working best recently.
Mm.
That's I'm pretty opportunistic. I go to the edge because I believe that market regimes and also strategies, they go in and out of favor. They're kind of sticky. That's my basic belief in the market, that you can actually gain an advantage because market environments stick around for some time. And if you adjust your portfolio, you adjust your strategies to the market, that can happen really quickly. So from one week to the other, I can throw out certain things and include others if I think it's relevant. For example, around option expiration dates, the options market analysis becomes much more important than at other times. And then sentiment indicators in recent months were really not doing anything to the market, while momentum was winning every single time. Every dip was bought.
Yeah.
And you just have to, I think you have to react to it. And if it changes, then you will lag behind. But that's the game, really. You have to consider, with every change in a short-term regime, long-term regime, you will get some underperformance until you adjust to it.
Yeah. Okay. So even though this is a systematic and quantitative-based model or approach, you still think that discretion has a place in managing it based on what's happening in the markets?
Yeah, I think so. I think the weighing of what is important at the moment is largely a discretionary process.
Mm-hmm.
Each data point should be verified to be quantitative and not just hearsay, like a technical pattern. If you say a head and shoulders, you would do your own studies, or at least find some studies from reliable sources to say this technical pattern does have a relevance in the market. For example, the head and shoulders, there is some evidence that it does, but a lot of other technical patterns don't. And of course, it changes. They sometimes work, they sometimes don't. But it's in the end, it's largely a random process, the market. So all the edges are going to be just a slight tilt into a direction. So if I say we have a 60% chance to be down over the next month, you can always invert that idea and say 4 out of 10 times that will be wrong. That would be the correct analysis then.
Yeah, sure. Sorry, I've got my dog in the office. I was just letting him out the door. So I was listening, but I was just away from the camera then.
Before he starts barking.
Yeah, it's breakfast time for him, so I can see he's getting a little bit agitated. Now, we've got a couple of questions in the chat, which I wanted to get to in a minute, but I've got a question here that I'd like to cover, something I saw on your website, actually, which I thought was quite interesting, and it's this concept of anti-edges.
Yeah.
Can you explain what that means? What is anti-edges?
Yeah. There's this article on the website about sustainable edges in the market, which is quite a long one, but it's probably one of the more fruitful ones if you want to go through it. And after going through all kinds of different long-term, short-term, technical, fundamental edges, I land at the opposite, the anti-edge, which is basically looking at everything from the inverted lens, which so you want to just avoid the worst rather than find the best, the worst securities, the worst strategies. And most important for me is you want to really screen out the noisy and useless information, which floods you all the time. And for that, it's good to look closely at who you're competing with. For example, if you want to do a factor strategy, you can analyze the market and see that's exactly what all the big players do, because an institutional investor really wants to be an outperformer without being different from the market most of the time. They can't really afford, there's so much career risk, they can't afford to be really different. An individual investor can. They can just sit out times when there's no really good opportunity and go big when there's a big opportunity. And a professional investor can't really sit in cash for months at a time if he wants to. And one really, really interesting idea that I got from that, from the screening out of noise, is always considering the base rate probabilities for any idea that I have. If I can get data on it, then this is such an easy heuristic to see, is it worth pursuing that idea? Is it just too difficult? And the easiest example is that I don't even look or listen to any news concerning individual stocks, unless just for the entertainment value, basically, if it's Tesla or GME or whatever.
Yeah.
And the reason for that is that there's plenty of studies that you can look at that tell you that up to 65% of stocks underperform the market average. So just by going there, if you look for an outperformance, you just buy the index rather than look at individual stocks, because the base rate is so against you. And it's even worse because I think it's only something like 3-4% of stocks that actually make a difference, that carry the entire outperformance from stocks over bonds or treasury bills. And just to imagine, you have to pick this 4%, one of the 4%, to be an outperformer. It's just incredibly difficult. There's so many analysts out there that are really smart. It's easy to just screen it out and say, I don't bother with it. I think the longer time frame to see whether the index can be timed is a much more fruitful endeavor. That's what I've landed at anyway.
I think that's an interesting concept or way to look at things, because I think that a common approach is to just look at stuff that works and just discard the rest. But looking at things that aren't working is also a bit of information that can drive your investing and trading decisions. So I think
it's even Charlie Munger and Warren Buffett have that as their hallmark. It's the basic tongue-in-cheek Charlie Munger quote that says, "We're only successful because we're not stupid, not because we're smart. We're just not stupid."
Yeah.
Often that's enough. And there's just so much useless information from news or the financial industry, which wants to tell you something, but it's not telling you how to outperform, but it's telling you, I want your attention, I want to sell you something, here's the magic system, things like that. So it's just a lot of noisy information out there.
Yeah. Okay, thanks, David. Now, we've got some questions in the chat, so I might just go to those. Let me just put, here's one from Google user. G'day, Google user. I'll just put it up on the screen and then we'll read it. So first of all, do you only invest in equity markets?
It's my bread and butter. So basically the short-term analysis is concentrated on equity markets, especially the S&P 500, because you just get the best and most reliable data on it. And I use other asset classes for my long-term investments, basically as risk-off or alternative investments. So the investment portfolio may rotate out of equities into bonds or cash, or alternative assets, for example, gold. Just in the recent last year's market crash, it rotated first into cash and then into gold. It has a systematic process to do that. You can read about that in the ebook on the website. It's all in there. and but they're not. I'm not concentrating for them, but sometimes I get signals. For example, I think it's the interest rate rise, the recent interest rate rise. It's really important for the equity market. So I use the bond market as a signal to analyze the equity market sometimes.
Okay. We've got a couple of questions about weightings here. I might just put up one, maybe this one from Chango. Here it comes. How do you determine the weight of new edges compared to the base rate when you decide to update your model?
That's a really good question. This is really, really difficult. A lot of the time, if you look at the market in a similar way over similar timeframes, a lot of the edges and studies, they will just cancel out. They will revert to the base rate. So it's actually just a few data points that work in your favor. And then I have some bread and butter strategies that I always use as an overlay. For example, a simple one that uses the option markets is that I have a strategy that simply buys a predefined dip in the market if we're in a long gamma environment, because the long gamma means that option market makers, to hedge their portfolios, they will just buy the market when it falls, and they will sell it when it rises. So it bounces back when it falls for a certain over a certain threshold, which is just a very simple strategy, and I can just put it in there, and it will tilt the probabilities as soon as the market drops just a little bit. Even if we're overall for the medium term, it's a negative idea, you just still buy it just from that small strategy, because that has, I guess, 70% success rate in this case.
Okay. Thanks, David. Here's a question from Mr. International. Here he goes, up on the screen, Mr. International. Like the name. What is your holding period?
Basically, I use a lot of options or futures to hold for around 1 month. That's the mean reversion time frame that I use to leverage. In reality, in practice, it's often shorter, because I use these certain short-term strategies that have a holding period of a couple of days to a week or so. And the index ETF portfolio, which is my long-term investment portfolio, only has a turnover of 1 or 2 trades per year. So it's a really long-term. It just wants to screen out the really bad bear markets, basically. Otherwise, it's always invested in stocks by default, because it's just considers stocks the most reliably high return asset class, unless there's a bear market, unless there's usually a recessionary bear market.
Okay. Thanks, David. Here's a question from Raphael. Excuse me. Let me put this one up on the screen. I haven't seen Raphael's name here before, so welcome, Raphael. How do you find new ideas?
I just read a lot. I really like to read. I listen to a lot of podcasts while running, and I think FinTwit is a really great resource where you can find lots of new ideas, lots of new people coming in, and if they have good ideas, they will automatically be recognized, which is really, that's why it's such a great instrument. It took me some time to get used to it. For a long time, I thought, well, a couple of characters, what good can it do? But it's actually quite good, and there's a lot of free market studies in there, for example, which show you exactly in a table form when you have, for example, a momentum where 80% of the stocks of the S&P 500 are above their 50-day moving average or 200-day moving average. This is what happens over the time frame of 1 week, 1 month. 6 months, 12 months, and you can actually see quite a lot of them out there for free, well done and everything. So that's a good one. And then there's go-to blogs, books that I use. Maybe there's one book I can name, which is not a mainstream book. It's more like it's a bit like the phone book for investors. It's it's called Expected Returns by one of the guys from AQR, the hedge fund. I would have to. It's a Finnish name, so I can't really remember it. I'm sorry, but it's Expected Returns, and it just shows you these long-term factor edges of different asset classes or performance and long-term strategies. They're really well analyzed, and you have tables and tables of these possibilities. Another guy I really like for the long-term investment is Meb Faber. He has a lot of free books out there. He runs an ETF shop and he also does a podcast, which is sort of a couple of years ago, that was my first investment university course, basically, to just go into all these investment strategies. He deals with trend and factors in a really, really good way. So you've in my ebooks, for example, I use a lot of his groundwork to lay out the case for trend following, for example.
Excellent. Okay. Thanks, David. Here's a question from Cam. G'day, Cam. In order of importance, how would you rank market indicators? For example, VIX futures, yield inversion, moving averages, etc.
I really like the VIX futures term structure. So that's good that you're putting that there. For me, that's one of the basic, very fast and accurate risk on, risk off indicators. So if the VIX futures term structure inverts, maybe not just slightly, but a little bit larger, of a certain threshold of an inversion of maybe minus 1.5% or something like that for a small inversion, and a larger number for a large inversion. So it has different sensitivities, and that's really a good risk-off indicator that you can use. I basically use it to scale down my exposure a lot and to really reduce certain strategies, for example, short volatility strategies that I've not been running them since last March, but before that, they were quite a good return source. Since then, they're kind of mixed up through the high volatility we're having right now, for me anyway. And I just get out of these strategies when the VIX term structure inverts. And for trend following, for example, I use simple moving average crossover. I don't use the regular ones. I use a little bit longer. So because there's often a lot of whipsaws around the 200-day or 50-day moving average. So I just use 60 and 275. And I often have these very simple parameters and use different sensitivities. So for the volatility indicators, there's two, and also for the trend, you have just the long-term moving average. If it crosses below the 275-day moving average, it's a signal. And then the next signal, the longer-term signal, is the crossover, the golden cross or the death cross with these slightly longer moving averages. And these are used for timing, and fundamental indicators, for example, are used to lay out the basic landscape of the economy. So if it's solid, if it's green, I use sort of a visual traffic light system for myself. If all the fundamentals show me green, then I will only use the very least sensitive technical indicators to time an exit from the stock market, for example. If if it's the yield curve is inverted and I have a red signal, I use a combination of 6 indicators in the meta strategy, 6 fundamental indicators. So if 2 or 3 of them are red, then I will get out of stocks much more quickly, as soon as the VIX term structure inverts slightly, for example.
Yeah. Okay. All right. Thanks, David. One last question before we start wrapping up here. This one is from Timo. G'day, Timo. Let me put this up on the screen for us. Here we go. When you found an edge in a new strategy, how big must this edge be for you to be usable?
Well, most of the day-to-day edges come from market studies. So I have these tables that show me a percentage positive return over a certain time period, and if it should be significantly different from the base rate. So, for example, if it's a medium term where the base rate is 60-65%, it should show at least 70%. Return probability to be considered. So in the short term, it's a little bit less, but the difference should be at least, say, 10% from the base rate. I do it a little bit more intuitively, but that's how I consider a study significant.
Mm-hmm. All right. Well, thanks a lot for your time today, David. Now, if people wanted to get in touch with you or learn more from you, how can they do that? Where can they go?
Well, I've got all the information and 2 free ebooks on my blog. So that's basically, I really like to lay it out what I'm thinking, and whoever is interested can read it and implement it themselves. And that's on my blog, which is systematicindividualinvestor.com. That's the blog where you find everything. And so everybody who wants to do their own work can use these frameworks and ideas by plowing through the articles on there. And I put out a monthly and a weekly report, which is a subscription which finances all my data feeds and all my subscriptions, basically, where you can read how I do the work that is laid out in these blog articles from week to week, and you can read what I'm thinking there. And I share a lot of that on Twitter, sometimes more active, sometimes less. And the handle there is @IndieVesting, which is spelled INDIE vesting, for independent investor. So that's basically it.
Okay, excellent. So we'll have some of those links in the show notes below this video. So if you didn't catch them, if you're driving or something, don't smash your car. We've got the links below the video. You can come back and get to those later. So we're getting some good responses in the chat. Let me put a couple up on the screen here. Ston said, "This was great." Django said, "Like." So actually, if you enjoyed what we shared today, please hit like on the video, and then also don't forget to hit subscribe so you don't miss any future content that we release. Raphael said, "Thanks." I assume that's to the question you answered earlier, David. So thank you. And Django said, "Informative session." So yeah, all around, lots of great information being shared by David today, and seems that everybody appreciated it. So thank you very much for your time today, David. And I wish you and everyone who joined us today all the best. Now, as for next week, there's no show next week because I'm unavailable. I've got some other commitments. So we're skipping next week, but come back the week after because we've got a new guest as well who's got some great stuff to share. And we've got some more comments here as we finish up. Brilliant session from Cam. Google user had some great questions in the chat. So thanks everyone for joining us today. Thank you, David, and all the best.
Thanks for having me, and I hope everybody got something out of my convoluted ideas about the markets. But you always have to find what works best for yourself. That's really the essence of investing and trading. You have to work at it and find something that sticks with you so you can stick with it. Otherwise, you'll just bail out when it doesn't work.
Yeah, absolutely. All right. What an excellent way to finish up for today. So thanks a lot, Dave. And thank you for everyone for joining us, and have a great week. Ciao.
Thank you. You too. Bye-bye.
Bye.